Hey, everybody. Welcome to the fourth quarter update from PFA. Coming to you today, it's November 21st, 2024. We're a little over halfway through the fourth quarter already. Hope everybody survived the election, had a nice summer, and is managing their way into fall. A nice fall to start off with. But we promise to keep things moving here. Quick introductions. Jim Bradley, our founder, Chief Investment Officer, is joining us as always. Welcome, Jim.
Thank you again for letting me join in the conversation, Sam.
And I'm Sam Chaplin, Portfolio Manager here at PFA. So the first slide we got for you today is on the dual mandate. Dual mandate refers to the Federal Reserve, who's got two mandates, as it says. One is to keep prices stable. Tough going on that recently, but doing better as of late. And two is to maintain full employment. So looking at that dual mandate on top here, we have inflation numbers coming down to 2.6%, well off the highs of almost 9% last summer. So solid progress there. We can see there has been some moderation in the progress, but that was largely expected. Inflation components that are still pretty hot are things like housing and auto insurance. Those take a while to reprice, so we expect that they will still come down moderately. As the Fed combated inflation by hiking interest rates, the concern is that could break the labor market. Companies could lay off employees en masse. We really haven't seen that. We're still at a little over 4% unemployment here. So that's a little high relative to recent history, but over the long term, still very low and a strong number there. So we are on the verge here of saying that the Fed has achieved the soft landing, which has only been done. This would be the fourth time in U.S. history that they went upon a rate hike campaign and did not end up pushing the economy to recession. So we're in a really good space here overall. That unemployment number we want to dig into a little bit because it doesn't always tell the whole story. That is telling us that out of the people looking for work, all but 4.1% have been able to find work. It doesn't answer the question of how many people are looking for work. That's what this next slide tells us, which is about the labor force participation rate, showing that we're actually back to pre-pandemic levels of people who are looking to participate in the workforce. So that is a really positive sign. It's always my favorite chart to show when people say kids these days don't want to work anymore either, because it shows that a lot of people are working these days relative to back in the 70s and 80s. So strong numbers there, and provides a good backdrop to say not only is unemployment low, but a lot of people are looking for work as well, which bodes well for the future. So outside of those indicators, we're looking at these NBER indicators, which this looks like a complicated chart, but what these basically are the different metrics that the National Bureau of Economic Research use to determine a recession. So outside of things like economic growth, they want to look at these numbers and say, were we actually at a contraction or not? And we can see out of these six indicators here, actually over the last 6 months, all of them have shown improvement. So that's another a strong case for having achieved this soft landing. That things like retail sales and household surveys and non-farm payrolls have been trending in good directions, particularly when it comes to real consumer spending, which has been the bedrock of this whole recovery so far. So in a good place in the economics point of view. I think, rewind the clock a year, and if we knew that we'd be here at this point, I think we'd all be very happy with that outcome, and that's been reflected in markets as well. But Jim is going to come in here and, throw some caution in there, which is always warranted.
Yeah, I don't want us to come across looking too rosy here because, while you're right, we've seen elements of a soft landing, which in and of itself is always incredible to me, because in order to bring in inflation, you almost have to drive up unemployment. And in order to drive down unemployment, you almost have to stoke inflation. So for the Fed to have been able to tackle both at the same time, it's almost like telling them they've got to, serve 300 million people dinner and keep the kitchen clean at the same time. So, but they managed to do it. So far, it looks good. Like I said, we don't want to paint too overly rosy of a picture. There's this thing called the SAM rule, which I had never heard of before this year, but it's dynamic enough that the Federal Reserve uses it as one of their key things to look at as to whether they think a recession is likely. Claudia Sam, who's an economist, noted this dynamic a while back, and it's been really, really predictive. Anytime we see an unemployment rate rise by more than 0.5% off of a 12-month low, historically, that has been the beginning of a recession. And so where are we? Well, back in August, we saw a more than 0.5% increase in unemployment from a 12-month low, and we saw the overall unemployment rate go up to 4.3%. Importantly, that level has kind of come back down a little bit. So, it's historically, every single time since 1950, we've seen that rule get triggered. It's been a recessionary period. Looking at this, it's had a perfect record so far. So what we don't want to see is it continue its perfect record. But importantly, Claudia Sam, the economist who developed this herself, just recently put out an op-ed pointing out that rules, including hers, are made to be broken, and that while she does see slowing growth, she herself, the maker of this rule, really questions whether a recession is currently in the making. So, we're having to dig around a little bit just to find, areas of wanting to be cautious about our optimism, but our optimism is relatively solid. One other thing that I can throw a little bit of water on our optimism is that the Fed has been giving us guidance as toward a lower interest rate environment, and for a while the markets were actually leading the Fed on that a little bit. Their markets were pricing in even further rate decreases than the Fed was putting out there, but that's definitely twisted and changed a good bit over the past few months. I think part of it has to do with the election. I think a part of it has to do with something we'll talk about as we go further into this, which is the possibility that the Fed may be a little bit more cautious and maybe a little bit more concerned about, is inflation really that much vanquished given some of the potential policies of a new administration. So now the market is actually pricing in a much wider range of potential rate outcomes, slightly higher than what the Fed has been giving us as guidance. I think that what we look at that is indicative of is a good probability that if nothing changes between now and then, the December meeting may very well result in the Fed kind of changing their trajectory, their dot plot, as it were, of where they see interest rates is going. So don't be terribly surprised to see the Fed kind of back off of their, the rate of interest rate cuts that they're projecting when they meet in December. And as I always like to point out, if that is the case, don't be throwing out the possibility of seeing a little bit of volatility getting kicked up on that as well. This is the next slide. I'm just going to lead it off. There's a zillion different analysts out there. This is just one of them, Ernst & Young, showing us a combination of their inflation projections before the election results came out, and the result of the election on what they saw as inflation projections. Two things here. One, it's higher. They're projecting higher inflation. Two, it's not way higher. And so it'll be, wait to be seen. Every new administration comes in with rhetoric pre-election. Then they come up with actual policy proposals, which are sometimes a little bit different than the pre-election rhetoric after the election. And then it has to go through the meat grinder of Congress, and what comes out at the end quite often looks very different than the rhetoric that we see pre-election. So this is one way of saying, yeah, higher inflation could be the result of, the tariffs, as a result of mass deportations, as a result of an increase in the federal deficit, but perhaps not to the degree that some of the most alarmist people and economists out there are projecting.
Yeah, I'm in agreement with that. We've seen a little bit of a tick up in interest rates since the election. I think there's kind of two components to that. One is that we're looking at moderately higher growth for the next year or two based on what we talked about earlier here, that growth is going to be better than maybe we expected a few months ago. And if that's the case, Federal Reserve might have to keep interest rates higher for longer to keep the economy from overheating again. And then another component in there, impossible to tell how much of it is but the fiscal policy outcomes from the election, of all the things that Jim mentioned, of potentially some moderately higher inflation based on those policies. But I always like to, shy people away from linear arguments in the markets of tariffs equals inflation, tax cuts equals inflation. I think if we learned anything these past few years is that we don't exactly know how inflation works. And, these same economists were telling us that, inflation was transitory, and then they were telling us we were going to be in a recession in 2023. So grain of salt to those projections. But just in general, none of this stuff happens in a vacuum. Maybe if you change tariffs and didn't change anything else about the economy, that in itself would be inflationary. But there are other components going on here. Some of these policies will lead to a stronger dollar, and stronger dollars are deflationary. So a lot of conflicting factors going on that want to shy away from kind of big roll. Same thing for the SOM roll. Inverted yield curve was a roll too, and that one's looking to be broken as well, as not necessarily preceding a recession. So useful, but not the end all be all. Moving into market performance a little bit here. This has been a really positive development. Looking at the last 3 months of stock market performance, the last few quarters, we were showing how the market cap weighted S&P was absolutely dominating the average stock in the S&P because of that Mag 7 outperformance based on AI optimism. We're showing here that the rally has really broadened out beyond just the AI optimism to a broader optimism about the economy based on all of the factors we've talked about. So here showing that the equal weighted and the market cap weighted have done just about the same over the last 3 months. And you can extrapolate that out even further, where small cap stocks have been doing really well. Risk assets like, even Bitcoin and gold doing really well as well. So just some really broad-based optimism that's been seen in the markets has been great for U.S. stock performance. Admittedly, not so much for international stock performance, which has gone just about the other way based on concerns around trade wars, tariffs, that type of thing, as well as a stronger U.S. dollar benefits U.S. stocks over international stocks. But a bit of a reverse of that, though, on the bond side, looking at the global bonds in blue versus U.S. bonds in green or teal here. Because the U.S. has stronger growth and it's going to have to keep interest rates higher for longer, likely, that has been a deteriorating factor for the U.S. bond market versus the international bonds in here, where a lot of these economies are not holding up as well, and they're going to continue to cut rates aggressively, and that's better for their bond market. So kind of a good problem to have for the U.S., but still not necessarily reflected well in the bond performance specifically. Last up here, just a couple things looking forward to. No surprises here. Geopolitics. Markets are pretty bad at pricing geopolitical risks. Not usually a big factor in market performance unless there is some massive type of escalation that impacts trade and business. So something to keep an eye on. Has been some pretty scary escalations in recent weeks. So it's something we'll certainly keep an eye on. And same with fiscal policy, as Jim mentioned. You got to be careful of listening to the promises made on campaign trails. I think I saw in the first campaign, Donald Trump made good on 23% of his campaign promises, which is only slightly below average, I believe. So to Jim's point, easy to have rhetoric. Policy is a lot harder to get through. So we'll look for those policy specifics, avoid listening to any rhetoric about, some of that rhetoric could just be bargaining chips. He says he's going to put a huge tariff on China. Maybe that's just a way to get China to the table and hatch out a new trade deal. So not defending any political or fiscal policies, but just trying to put it in perspective.
The very day that we're recording this, I mean, we've got the second of 2 days in a row with ICBM attacks between Russia and Ukraine, jolting markets when the news first comes out. And yet, in both days, the markets have resolved at a higher level. So again, just to reiterate what Sam's saying, both in the realm of geopolitics and fiscal policy, we're certainly seeing things that should be kicking up volatility. by anybody's standards, but the market is remaining kind of sanguine. So it's one of those things where you never want to try to take a really sharp turn in your portfolio allocation based upon some rule of thumb or some just general sense of what either a geopolitical event or a fiscal event is going to do. Definitely fade it in. And that's exactly what we're trying to do as we try to get a better feel as we get across the new year into the new administration, what policies and what global geopolitical events are going to look like. That's what we're doing for you.
Excellent. Well, I think we did all right on time there. Thanks everybody for joining us again, and we'll see you next quarter.
Even next quarter. Happy holidays, everybody.
Yeah, happy holidays.